People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again, and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, you can find us at zinniawealth.com, Zinnia wealth.com. Spell that right out there, and it's time for you to start thinking and planning your retirement, and that is why we have this show. Charisse is here. How are you doing today?
You know what? I'm not burnt. I'm tan this week. Lobster season, it was mini season. We took the kids down there. We had so much fun. Obviously, I've come back with a little cold, so I sound a little funky. But while we're down there, check out our Instagram and Facebook and LinkedIn pages, because we posted a lot about retirement and what lobstering has to do with retiring. And just taking the time to experience life differently than maybe other than just the typical. I know a lot of people out there don't like travel, and then I know a lot of people who do like travel, but then they're always looking for a new experience, and going down to the Keys is another amazing experience. So we caught lots of lobster. We had all the kiddos down and have amazing pictures, and it was just so much fun, and it was relaxing, and everybody needs to relax and not always follow the calendar and the tasks that you put on it, because if you don't save time for fun, what's the point of what we do every day?
There you go. Yeah, if you're listening on our podcast and you're up in the Northeast, these are lobsters without big claws. These are, you can see Charisse holding on to them, and there's nothing that's going to bite you there, right?
Well, they're tentacles. I don't even know what we call them. They're pointy, they're spiny, and they hurt. So you might want to wear a glove if you're brand new at it.
Watch out for that part of it. Okay.
Well, and here's the other things. A client said, "Well, I wish you would have done a video on social media about how you actually catch lobster, Cherie." So you know what? Maybe I'll do it real quick on podcast here and radio. You take a net. You dive down and you take this little tickle stick that's 3 foot long, and you go under the rock and you tickle them out of the rock, and then the net catches them, and then you bring them up. And that's that easy. And so you got to hold your breath, though.
How deep of water are you in?
So we normally do Bayside in the Keys. We go to Islamorada. That's where I'm from. And we decided the ocean side was so calm. I've never in 20 years seen it this calm. That was like, let's go venture on the ocean side. And we were diving in 10 to 12 feet of water, and we were just doing just fine. We had all the kiddos out there. Ella was catching lobster like a champ, like way better than I ever did. She's got a finesse and just a softness. She would never let one get away. It was amazing to watch the kids grow into this. And Eli, he went down, but he'll probably be catching more next year.
All right.
So it's a fun thing to do with the grandkids and families if you've never done it. And, come in and talk to me. I'll tell you more about it.
There you go. All right. Always fun in the first segment here of the Adventures of Charisse, because there's always something to talk about. That is for sure. And we'll talk a little bit about your trip up to the New York Stock Exchange as well. So you did a little of that too. So we'll get into that a little bit later on. So let's talk about that stock market as we get going here. There are people out there right now that are just kicking themselves. And and the reason is because some people took a look at what President Trump was going to do with the tariffs and everything. And they said in April, they saw what he was going to do. April the 1st was Liberation Day. And then all of a sudden the market went down, and they kind of saw that coming. So they said, I knew it. I knew he was going to do it. So they went to cash. They said, I'm going to get out of the way.
Yeah, a lot of people went to cash.
Yep.
And then guess what?
It went back up.
The market went back up. They stayed in cash.
Yep.
And then they missed the run up. And so a lot of those people are now I got to wait for the next dip before I get back in.
Yeah.
And this is your market timing conversation, Randy. It's don't time the market. Just put a little bit of money in every month. That's what dollar cost averaging is about for the younger people who are still saving. But even if you're retired and you're self-managing your money, there is no crystal ball, and you're going to potentially miss out an even bigger run up. So again, This just tells me, Randy, when people are buying and selling and then not sure when to get back in, that they want to get involved. They love the idea. It's exciting, but they don't know how to get out at the right time. They don't know when to get in at the right time. And now you've missed, 5 to 10% run up, maybe even more. Mm-hmm. And that tells us, right, Randy, that they are too risky in their portfolio, or they don't really know their risk tolerance. And so their risk needs to be reassessed. I think that's key, right?
I think that it isn't like behavioral finance is that the loss of money hurts 3 times worse than the exuberance and the wonderful part of gaining money. If you win a hand at blackjack or a couple in a row in Las Vegas, that gives you one feeling. But if you lose 3 in a row, that feeling is much worse than the feeling of making the money.
It's 1,000% true. And that's when we get emotional, psychology of money. We make bad decisions. And when the market's going down and you're losing, people want to emotionally sell. Mm-hmm. And that's the worst thing you should do, unless you got a game plan, you know exactly when you're going to get back in. And 9.5 out of 10 people, if you can say that number, it doesn't work, right? Yeah. And so that's why it's important to have that financial advisor in your life, just to shoot off the hip with, ask questions. Hey, I'm doing this. What do you think? And we're going to say, bad idea, because this is a short-term roll through, right? Yeah. And it's probably going to come right back up. This is short-term swings, and we're investing for the long term. And like what we do here at Zinnia, Randy, is we're already maneuvering portfolios. We have one portfolio that trades once a month when needed, and it has been trading every month. We have one portfolio that trades quarterly. We have a dividend portfolio and a growth portfolio that trades quarterly. We have notes that just, they come due based on different indexes. We sprinkle in a little bit of annuity. So we have a basket so that our clients are like, okay, so we got this safe money. We got this. If the market goes down, we can potentially make money on this account. If the market goes down, we got this dividend we can pull from income. We have this interest-bearing account. We have, Sharice put me in a blockchain or Bitcoin portfolio, which we're not doing much for clients, but I just had a client said, hey, I want to go in your Bitcoin portfolio. So if you want the risk, I'm a big fan of Bitcoin, but I'm not a big fan of putting it in my clients' portfolios unless you got money that you're not going to worry about for like years to come, right? So having a strategy, reassessing your risk, because we don't have a crystal ball. And that's the big lesson when it comes to the market timer. Yep. And I know a lot of people are retiring, Randy, and they're like, now I've got all this time to really follow the stock market, and I'm going to be better than my advisor. And I always tell everybody, go ahead, do it. And within 12 months to 18 months, you're right back in the office and you're like, okay, I got this wrong. You know what? Yeah. I'm handing this back over. But we want people to learn lessons, not big lessons, but right when you think that you're better than your financial advisor. Some of you actually might be, by the way. Just be cautious, especially if I give you a quiz with 10 questions and you think that you're going to get 5 out of 10 right, you should not be investing on your own.
Well, I think that the whole idea, you might be right once. I mean, in this situation, maybe you saw the tariffs coming and so you got out and went to cash in March. Okay, so you were right. But then you have to be right again when you figure out when to get back in. And trying to do that over and over and over again, there is nobody who's been able to figure that out. We would be reading their book, and they would be on their island, and they would have their yacht, and we would look at them. They'd be the next Warren Buffett.
If it was easy, everyone would do it.
That's
we would all be on a yacht.
So the answer to that is our discussion always about getting a handle on what you feel about risk. Is I don't like losing money. Okay, let's build something for that. I don't want to have my toe in that water, more than 10% of my money. Okay, let's build a portfolio for that. That's what we do. And it starts with a conversation. Give us a call. Let's take all that market timing business and just set it aside and come to grips with where we want to be with our money. Let's have a plan. 833-368-3680 is the number. 833-368-3680, or use the website, which is ZinniaWealth.com, ZINNIA Wealth.com. There's a box there. It's a gold box. It says Complimentary Retirement Consultation. And if you click on that, there'll be a place to put in a little information, and our team will reach out to you. We'll get a date on a calendar and talk through this. Again, ZinniaWealth.com. We all worry about running out of money, and that is just the number one fear of people getting into retirement. And it's not just the people who are regular folks. It's people who have a lot of money as well. There's an interesting survey out there that took a look at a whole bunch of different surveys and said, if you have over $1 million saved, ready for retirement, are you worried about running out of money? And in 3 different surveys, one said 33% said yes, the other 45% said yes, the other one 48% said yes. Even people who have a lot of money are worried about running out of money.
Yeah, it's crazy, Randy. When you have a survey and the survey says over 40% on average, people are worried about running out of money that have saved $1 million or above. Houston, there's a problem.
Right.
And the problem is that we've gone through accumulation phase our entire lives. We've been putting our heads down, saving our money, and growth. Don't sell. And like my buddy Ty Lopez, he's one of my mentors. He's like, it's all about wealth and generating wealth. And so I had to like debunk that a little bit. I'm like, okay, yeah, it's about wealth during the accumulation phase, but then during the decumulation phase, it's about income planning. It's about income streams. How do we make sure those paychecks show up even if the stock market crashes? And how do we do that without having to really worry about running out of money at the end of the day? So there's that accumulation phase and growth, but then there's also that decumulation phase and the income plan, because we want different checks coming from different sources. I want my clients to have 5 different paychecks.
And that really is the key, I think, to people setting this, I'm going to run out of money, or I'm worried about running out of money. If you can show them that there's money coming in every month, that the bucket's getting filled, and then you empty the bucket, and then the bucket's getting filled, that's going to make me feel better, because like right now, I don't worry about running out of money. I have a job and I get paid every 2 weeks. That takes that worry away. Well, if you're in retirement, you don't have that job. But if you know that the money's coming in with a good income plan, Sharice, I think that's the answer.
Yeah, income makes the world go round. And if you don't have an income plan as you're rearing up for retirement, and you're specifically in retirement, yeah, you're going to feel insecure about your plan. You're not going to have confidence. There's no transparency. You're like, I'm just going to take a chunk of money off of the top, and all of a sudden this chunk of money starts to go down. You're like, wait a minute, I can't spend as much money because now my chunk of money is going down. And then you're not living the lifestyle you should be living in retirement, enjoying those dollars that you saved up for. So this is why it's important to have a financial planner that helps you figure out the income phase of your life. And that's the day you turn in the keys to retirement and you walk away, collect your last paycheck, and boom, we need another paycheck coming in and from many different sources.
So all these things that you've done for retirement, whether it's a 401k, an IRA, a Roth, you bought property, you put money in savings, you've done all these different things. Then you get to retirement and you go, well, all right, how does this pay me? That's an income plan, and that is really job number 1. Let's see what we can do to do our very best to replace that paycheck in retirement. Give us a call. Give us a look on our website. Here's our number. It's 833-368-3680. 833-368-3680. You can also use our website, which is ZinniaWealth.com, ZINNIA wealth.com. Bottom of the page, you'll see a gold box. It says complimentary retirement consultation. That's exactly what it is. It's a no obligation, no cost meeting where we just go through what you've done for retirement, try to give you a real good look at what your future looks like and answer your questions. That's ZinniaWealth.com, and the gold box that says complimentary retirement consultation. All right, so a lot of people get tired of work. You get into your late 50s and your early 60s and you go, oh my gosh, where's the finish line? Well, this woman, her name is Terry, and she is in Chicago. Her commute is 2 hours each way, and you can just tell it from her voice. She is over it.
I'm just tired. I'm just stinking tired. And there are days when I just wonder, how much more can I do? I mean, I'm not retirement age yet, so still got to crank it out. But man, there are days when I just go, can I do it now? Can I just call it a day? I don't know.
You can just hear it in her voice. Sharice, yeah. I got to believe that you have experienced that exact attitude when somebody walks through your door.
That is amazing, because so many people that come in our doors say, I'm just tired of working. I really want to know, can I retire now? Or do I really have to wait 10 years, 15 years, or 5 years? And this is probably my most favorite part of the job is being able to create these income plans. And our advisors do the same thing. And they all agree that income planning with clients gives them, this smile on their face. They sit back in their chairs and like, oh, wow, I can actually retire. Because if this young lady had come in and did an income plan with us, we could tell her, hey, you actually can retire in 1 year. You could retire in 2 years. You don't have to wait 10 years. And what does that do for the average individual? Well, it probably takes a lot of stress off the table, knowing like, I got a deadline, I got an exit strategy, right? And then when times are tough, you're like, it's okay, I'm going to get through it. Because you know what? I got 6 months left till I retire. Then you got something blows up at the office and you're like, I got 3 months left to retire and I'm out of here. And, it gives, and people just feel good about that. So how can you feel good about where you work, when you think you're going to retire, or how much money you saved if you don't know when your exit is? So we talk about exit strategies in the stock market and what we do to help our clients, but what is your exit strategy from work? Like, can you retire at 50? Can we do it at 55 or 60? Or do you really have to wait to 70? And I dare everybody to come in and talk to our advisors and figure out when your actual exit strategy is, because 9 out of 10 times it's a lot earlier than what you will ever imagine, which is crazy, because with our amazing software, we're able to show that to you in a split of a second and just the simplest manner. And I mean, for an example, I was just in the Village's office and I was sitting down with a 57-year-old and a 60-year-old, and the husband said, Charisse, I retired from the military, have a military pension, and I just feel like I'm never going to be able to retire. And I've already seen his portfolio, and I'm like, okay, so I got to figure out why he thinks that. And it's the same story over and over again. You have $1 million, $2 million. He had he had $2.2 million, and he was afraid at age 60 he couldn't retire. That human being, that family could retire that day if they wanted to, yet they didn't know it, because they just thought they needed more. And they need like $120,000 in income. That's their goals. That's their wishes. That's what they live on now. And they want to be able to spend freely in retirement. So when we put the income plan together, I said, on a pessimistic viewpoint, this $2.2 million with your VA and Social Security, and you're clicking in here, all these income streams, I said, when you are 90 years old on a very pessimistic low rate of return and a reasonable rate of inflation rate on top of that, you still have $4.8 million. I'm like, what are you worried about? And he said, he went, well, I didn't know that. Mm-hmm. How did you figure that out? And I break it down. We show them. And he's like, oh my gosh, so I can retire today. He's like, here's the good news, Charisse. I'm not ready to retire today, but I know the next time I get ticked off, I am walking out that door and I'm not even giving my 2 weeks. And I laughed.
I love it.
So, and then I said, your guys are asking for $120,000 in retirement. I'm like, let's fluff our numbers. Why not 170? Let's really wine and dine and go first class if you really want to, and make more trips than you ever expected. So we put 170, and it dropped it down to like 3-point-something million by the time they're 95 years old. And they went, oh my gosh, we can spend that much in retirement. And his wife was already spending or writing checks. It was pretty amazing. But how do you know that as an individual if you don't understand a plan? And he's a smart dude. He does all of his own investing. It's not like he doesn't understand it, but people don't understand the income planning phase of life. They understand the accumulation phase. We've saved, we cut coupons, we do all this, but they don't get it when it's time to write themselves a check and create that income so that they can live their go-go years and their life and their golden years the way they should. So that is a problem for me. And people spend less money because they don't have a plan. So get a plan.
So that meeting can come out a couple of different ways. If you're like Terry from Chicago and you're just kind of going, I just can't figure out how I'm going to go a couple more years here. And why don't you come in and let's, as Charisse says, let's do the math on your retirement. Let's put pencil to paper and figure out exactly where you are and what can happen. It could be, hey, we've got some work to do. How does it sound 1 year from now, 18 months from now, 2 years from now? Then you've got a timetable and you can see the light at the end of the tunnel, and it's not an oncoming train. You can see that, and that is going to bring you back to work with a whole new attitude, just like Charisse was talking about. But sometimes the answer is you can retire right now. Well, now you have a decision. Do you go back to work or you pull the trigger and do it? So these meetings can come out a lot of different ways. We would love to sit down and work with you on it. Give us a call. Give us a look on our website. The number is 833-368-3680, 833-368-3680, or use our website, which is zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. Click on that, and you'll be on your way. You know, Charisse, I was going to save this for next week, but we got a couple of minutes here, and I think I can just throw this in. The average spend for a household in retirement, we're talking 2 people, okay, age 65 to 74 is $5,400 a month. The average Social Security benefit for a couple is just over $3,000 a month, which means if you want to have a nice retirement, think about how much you have to pull from your investments.
Not a whole lot.
$3,000, $4,000, $5,000 a month. If you've saved $1 million or $800,000 or even $500,000, that math works.
If you've saved $500,000 and you need $5,400 and you're collecting $3,000 in Social Security, you're going to be able to survive retirement. You just have to have the right plan and asset map. I call it an asset map because you got to have different strategies built in so that you can always pull those dollars. But yeah, easy. $500,000, $3,000 Social. You need $5,400 a month. You got this, no problem. But how are you going to figure it out if you don't know what investments? Because you can't just go old school and go 60-40. That's the one thing I'm going to tell you, and that's why you come in and work with a financial advisor that understands this stuff.
It might not be as hard as what you think it is.
No, totally.
And when that's what I hear from Charisse over and over and over again is people come in really, really worried, and then when it's all done out in front of you, the math is done, and you go, hey, that could work.
Wait a minute. You mean I could have figured that one on my own, Charisse? But most people won't. Like, it's me and social media. I'm trying to figure out this. My mentors want me like, Charisse, you need to do more on social media. You got to do this and this ad. And I'm like, oh my God, just do it. Tell me how much it costs. Get me there. You know what I mean? It's like, I don't really want to be so intrinsically involved. I just want to know what's working.
Yeah, exactly. And I think that's the way a lot of people feel is, you know, I've written out my bills all these years. I've budgeted. I've done all this, but now I'm in retirement. I don't have a job. I don't know how to go about this. Well, let's help you. Give us a call. 833-368-3680. Again, 833-368-3680. Or use our website, which is zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. Click that and you'll be on your way. All right, people are always asking, where do I put my money? They know I do this show with you, Charisse. They ask me, where should I put my money? I just go, talk to Charisse. And so anyway, there's an article in Wealthopedia, and it says, well, here are some places not to put your money. Okay, so they have 7 of them here. So I wanted to get your thoughts on this because people come in all the time and they have money in places, and you might say yay or nay. We have to adjust this. This is good. Let's leave it there. Let's get rid of this. Okay, so the first one on the list, not shockingly, is variable annuities. So we've talked a lot about, you know, the downside of some annuities, Charisse, and this is kind of at the top of the list, isn't it?
So where not to put your money, number 1 on my list, variable annuities. Oh my gosh. Variable annuities are loaded in fees. Most of them, I would say 9 out of 10 of them are loaded in fees. They usually start at 3%. I've seen them as high as 5%. I will give you an example. No joke. This week, we had a family come in and we're reallocating their assets. I'm like, oh, hey, Charisse, we got this variable annuity still. I'm like, variable annuity? Where did that come from? Literally, they've had it for 5 years. They literally just came on board with us, just so you know. But they've had it for 5 years. They put $425,000 into it. It's 5 years later at $450,000. And that's because the fee was 4.5%.
Oh, wow.
So you got to make 5.5 just to like break even. So I said, well, why don't we just roll this out of this variable annuity into an index annuity that has no fees? When we moved that variable annuity to the index annuity, they got a bonus. So it went from $450,000 to $500,000. They're like, wait a minute. We just made $50,000 on it. I said, yes. And your cap on the S&P 500 is double than what it's at right now. in your investment, and now you have no fees. They went, OMG, Sharice, like, whoa, that is like magic. And I'm like, it is. So again, I am not a fan of variable annuities, so big thumbs down.
All right. So there's a lot of annuities out there, really thousands of them that you can choose from. And Sharice, do you use, I mean, how many do you actually use?
So there's thousands of annuities out there, and we really stick to the index or fixed annuities. And I can count on my right hand how many we offer.
Interesting.
And there's like 5 out of thousands. And we like real indexes. We don't like fees. We don't want losses. We want to be able to take a withdrawal out of it. So these aren't your grandma and grandpa's and your mom and dad's annuities, these old school annuities. These are the new age growth annuities with no fees. And if a lot of people hear about these hybrid annuities, most people don't need a hybrid annuity or equity index annuity. We like those. Variable annuities, no. Out, scram, move out of the way.
Get rid of them. All right. So number 2 on the list of the things where you shouldn't put your money, this was interesting to me, whole life insurance. And I remember when I was young and just got married and needed life insurance, and that was offered to me, but boy, it was expensive. So I decided to do what everybody else does, and I did term. And then I ran into a problem when I got into my 50s because that term policy expired. Now I got to buy insurance, and now it's really expensive. So
yeah. So let's talk about whole life insurance. So the older we get, I believe we don't need whole life insurance because of the cost of whole life insurance. If you get whole life insurance, it's actually better to get it when you're younger because it's going to pay a dividend. And as long as you hold it for 30 years, it is a more expensive policy. After 30 years, you're probably not going to have to pay a premium anymore. So there could be some value there. But when you're younger, you do term to cover the mortgage and cash flow if you happen to pass away early and you have kids and the surviving spouse needs income. So, but that term runs out after 20 or 30 years. And so you got to plan early. So it's not just about term early on. If you're looking for a potential investment for the long term, people can do whole life. But again, I'm not a huge fan of it.
Next one on the list of places where not to put your money. And I will tell you, folks, there are trillions of dollars in these, and they are in your 401k in target date funds. And we've talked a lot about them. What is the problem with target date funds, Sharice?
Okay, so boom, boom, boom. Target date funds. I am not a fan. Things that we don't want to invest in, but sometimes we're forced because we have a 401k. You have a small menu in your 401k and you're forced. But hey, here it is. Target date funds, they don't protect and they don't make as much money as you think they should be making. So I'm just not a fan of target date funds. They tend to have a little bit more fees. If you're with an employer, I'd rather you stick to the mutual funds, even though I'm not as big of a fan of a mutual fund. But if I had to choose between the two evils, I would pick mutual funds over target date funds. So if you have a 401k and you're like, oh, I got them both, come in and see us. We'll analyze your 401k because I was like, let's get rid of that target date fund. And we can tell you why when you come in and pick the juicier mutual funds, because in the long run, we feel like you're going to make more money at those.
Well, if you're 59 and a half, you do have that option of moving money out of your 401k to give yourself some more choices. So, Sharice, the idea of a target date fund is that they will add more bonds as you get closer to retirement, supposedly giving you less risk and more protection. But if you start to look at the performance of target date funds, sometimes you could pick one like a 2065 fund and find it doesn't do that great. I mean, there's a lot. You got to look at the performance of these things.
Yeah. So second reason I don't like target date funds is that as you get closer to retirement, it reduces your risk to equities, gives you more bonds. And you don't really know it's happening, but it's happening. But if you're 10 years before retirement, I don't want my clients to be in bonds. We got 10 years to grow our money, maybe as we're 5 years before retirement. So you have no control and it just does it. And then I feel like you lose out on the up of the market when maybe you might not even be retiring till later. So this is why that financial advisor is good to say, nix that target date fund and let's go with the mutual funds and play it heavy for the short term. And then we can slowly build in the safe strategies as you're, 5 years into retirement. So you really got to plan.
All right. So our list here of places where not to put your money that we're going through: variable annuities, whole life insurance, target date funds. Next one on the list is 401k selections involving company stock. So can I say one word to you? Enron. I mean, honestly, there is some risk when you put money into your own company stock. I don't think that's a bad thing, but it's all about how much, isn't it? It's the allocation.
So when we're talking about where not to put your money, a lot of employers, they will give you company stock at a discount, right? So let's say you work at Duke and the stock's at for example, $35 a share, maybe you can get it for 30, right? Because you work there and you're saving. But a lot of people will retire with all this company stock. 75% of their money is in company stock, and that is not diversified. And some of that stock, depending if it's qualified or not qualified, you're having to cash it out over the next 5 years, have be hit with some pretty big taxes that you weren't expected. Some of them are just in IRAs, and we got to slowly exit those stocks. So again, there needs to be a plan for those stocks, and I prefer you to, okay, let's take some of that stock, but let's also sprinkle in some other things that 401k has so you have some leverage when you're ready to retire.
The next one on the list here of places where not to put your money, and I'm in the dark on this one, Charisse, is a stable value fund. I know that that's probably in your 401k. What is wrong with a stable value fund?
So another place not to put your money in a 401k is a stable value fund. And the reason why is because it's stable. Very little value to it. It's not making any money. And so when interest rates tend to go up, they do make more money. But on average, we're looking at 0.5%, 1%, maybe 1.5%. Why is anybody's money in a stable value fund? That just means that you are ultra conservative. You're not sure where to park your money, and where there are some other options that you could park your dollars and still keep it rather conservative, but maybe make 3%, 4%, 5%. So I'm not a big fan of it, but people put their money there and they leave it there because it's safe. So that just means they need to reassess their risk and figure out, okay, if I'm going to be this safe, how can I make more than 1 or 2%?
So could I say at this point in this is you talk about active management. What these things are trying to do is do management of your money inside your 401k. If you're 59 and a half, you have that option of moving that money out and having it managed by someone like Charisse. And is there anything that these things are doing that you can't do?
No. So when people turn 59 and a half and you have a retirement account, a 401k, most companies, 9 out of 10, will allow you to do an in-service distribution. You can still contribute. They'll still do your matching, but you can usually move 50% or even all of it out to an IRA and start working with a local financial advisor. And the difference is you have 30 options with your employers in these 401ks. When you come to us, we have 30,000 options. Now talk about sky's the limit, right? The world is your oyster. Take advantage of it when you get the opportunity to do that. So be calling your employers now if you're 59 and a half and older and say, hey, can I move this out? Can I start working with an advisor and still contribute to this account if I'm going to work for a couple more years and still get my matches? And 9 out of 10 times they're going to say yes. And when you move your money over, there's no taxes or no penalties. So take advantage and be aware of what you are allowed to do, because if you do, the potential of growth or strategic planning when you want to retire in a year, 2, 3, 4, or 5, you're already ready to rock.
Love it. All right. We're going through our list here of 7 places where not to put your money. It started with variable annuities, whole life insurance, target date funds, 401k selections where you've got company stock, stable value funds, and the next one is mutual funds with loads. So explain that to me.
Mutual funds with loads. We talk about this in our workshops. We talk about it on radio all the time. Mutual fund with loads just means, okay, so we went to a big bank, we went to a big brokerage firm, you find them on every stoplight of the corner as you're driving by down the road in any city you're at, and you walk into those brokerage firms and banks, and all of a sudden you say, hey, you know what, I think I'm going to invest my money here. And like, oh, we're going to put you in 4 mutual funds. Oh, great. Dave Ramsey said, put your money in mutual funds and set it and forget it, right? In the meantime, you possibly 9 out of 10 times are working with a transactional financial advisor, and that loaded mutual fund will pay them, that's called a Class A share, will pay them 5 to 7% up front. So if you go in there and say, okay, I'm going to invest $100,000 and it pays them 5% that moment, like the next day they get paid, you're only investing $95,000. So for that advisor and for you to create a good relationship with them, for them to make more money off of you, they got to sell it and put you in something else. So we call it churning. Are they really doing the right thing for you? And so we're not a big fan of loaded mutual funds. I like no load mutual funds where there is no commission, right? So if the advisor is working for you, they're working for you, and they're not buying and selling to fill their pocketbook up. They're buying and selling because it's really the right thing for you in your portfolio.
Well, last on our list here, and Charisse has gone over this, and this just kind of sums everything up here, is people who just simply leave their money in their old 401k. Maybe you aren't even at that job anymore, and you've maybe got 3 401ks with old employers. Charisse, tell me why people should not leave their money there, even if it's probably performing well.
Yeah. One of the biggest mistakes that people make, I don't care if you're 30, 50, 60, 80, is that you bounce from job to job and then you leave these retirement accounts, these SEP IRAs, simple IRAs, these 401ks with these employers. And it's sitting making money most likely, right? But you just leave them and there's no plan. So here's the nugget here. If you have an old 401k with an old employer, do you know, it doesn't matter what age you are, you can actually now take control of those old retirement accounts, roll them to an IRA locally, pick that financial advisor that you love the most, and now they can start working on those dollars that might work for your future. So don't be afraid of it because there won't be a penalty. There will not be taxes to do this. Do not leave your 401ks with your old employers. Move them, get control of them, be prudent, because I know you all want to be, and I know you all want to learn a little bit about this stuff. So if you work with somebody locally, guess what? You're going to learn some stuff while you're moving it over.
All right. So maybe as you're listening to this list, you go, I've got a few of those. Variable annuities, whole life insurance, target date funds, 401k and company stock, stable value funds, mutual funds with loads, and leaving your money in your old employer 401k. That's the list here of places where not to put your money. And where do you put your money? Well, there's the question that you can sit down and talk to Charisse about. Getting control of your money, getting active manage of it, and having somebody that you can work with, ask questions of, and we'll make those adjustments as our economy does its dipsy doodles, as we have seen over the last couple of years.
Did you just say dipsy doodles?
I did say dipsy doodles.
That was so cute.
It just came out. Okay. All right. Give us a call. Wait a
minute. We're going to make a t-shirt called Dipsy Doodles.
Dipsy Doodles. Yes. Don't let the market do a dipsy doodle on you. 833-368-3680 is our number. 833-368-3680, or online you can find us at zinniawealth.com, ZINNIA wealth.com. There's a gold box on our website. You'll see it very easily. It says complimentary retirement consultation. Let's get an analysis of what you got and tell you what's working and what's not working. And if you've got some questions about retirement and how it's all going to work, let's get them out on the table and get them answered. All right, so Charisse, I love to go to the Market Watch Ask the Advisor column because I get a lot of interesting stories here. Sometimes they're about people who are not happy with their advisor, like this guy. And I'm just going to kind of give you an overall of what this guy is calling in about. And it's when the election was happening last year, he heard Trump talk about tariffs, and he got nervous. He has $2.7 million. He's ready to retire. He doesn't want to lose a lot of money. So he calls his financial advisor, says, get me out. I don't want to be at so much risk. I don't want to be in the market. No response. No call back.
No system.
Yeah. April happens. Market goes down. He starts losing money. He calls his advisor. No response. No call back. Then finally, after all of it was over and all the dust settles of all the loss of the money, the advisor calls him back and says, you probably shouldn't try to time the market. Now, okay. That's probably the advice that he needed to hear, but he needed to hear something.
So this is where the financial services industry totally fails.
Yep.
The financial services industry fails to communicate with their clients when markets are going down, right? Or when they're going up. And then the client starts to call the advisor and the advisor doesn't call him back because maybe they're too busy or they're like, we're just buying and holding. What's he calling for? Or maybe this person calls a lot. So communication is key when you have a sound relationship with your financial advisor. And if you cannot communicate with your advisor, Houston, we have a problem. You should be able to call the advisor, and if the advisor's not available, talk to their wingman in charge, their director of operation, or the person who's in charge of your assets under management account or your annuity accounts. There's always somebody that is available to talk to at least talk you off the ledge from making bad decisions until the financial advisor can call you back. And maybe it's at the end of the day. That's okay. But failure to communicate is one of the biggest issues in the financial services industry, and making sure that client feels safe and sound. And this is why we do radio. Our clients, all they got to do is listen to our podcast, and they know we're here. Here's our voice. This is what's going on in the market. We send out weekly newsletters. We do social media posts when markets are collapsing or going up. What should you do? The big, beautiful bill. We started talking about that. People know how to find us, and they can just pick up the phone and call us and talk to our team. If I'm not available, there's always somebody to talk to. And I'm going to be honest with you, I'm mentoring with a guy named Joey Coleman. He wrote a book of how not to ever lose a staff member, and we follow all the rules. And now he wrote a book, How to Never Lose a Client. And we want to make sure that the relationship we start with our clients, we continue year over year, 10, 20 years down the road, bringing that same customer service we did on day one, on year 20. And because that is really important to us, we work hard to get our clients, and just training our clients. Here's our system. This is how we do it. This is when our review is. Here's our movie event. Here's our shredding event. And, staying in front of the client. And the mission for a financial advisor, it should be how to communicate with your client, put it into a process and procedure, and make sure it does not fail. If it fails, fix it. So that's an issue, because this guy who called in and said, hey, I want to sell and go to cash. You know what? If somebody calls and says, hey, we need to go to cash, we need to get them in cash as fast as we can. Yeah. We need to talk to them and say, why? What are your concerns? Okay, maybe this is a quick little downturn in the market. Are you sure you want to do this? Because then you got to call us back to get back in. And are you going to make that decision? And so a lot of conversations have to happen. But maybe he just needed the cash. He needed a down payment on the house. He wanted to make sure he didn't take big losses. And maybe he wasn't going to give that money back. So there's a lot of rhymes and reasons. But if you can't get a hold of your advisor or the people who are able to handle that for you the same day, Houston, you have a problem, and it's time to start finding an advisory firm that is capable of helping you in times like that.
Well, there's an old saying, and I know this is going to sound like a bumper sticker, but it's true. People don't leave their advisor due to lack of performance. They leave because of lack of communication.
Yes.
And it is so true over and over again. We don't want that to be happening to you. If it is, it's time to look for a new advisor. Give Charisse a call. Kick the tires at Zinnia Wealth. Let's see if we're a good fit together. 833-368-3680, 833-368-3680, or our website, zinniawealth.com. All right. Lastly today, we're going to talk a little bit about your IRAs and your 401ks and your RMDs and all of those abbreviations that we have in the financial world. A recent survey done by Fidelity found that 72% of seniors, people in retirement, wish they had started a Roth IRA sooner. Half of them are saying they're paying more taxes now due to RMDs than what they thought. So, Charisse, we don't have a time machine, and we can't go back in time and say, okay, let's fix this. So what do you say to somebody who gets to RMD age and finds, holy cow, this tax bill, I never thought about this, and let's try to head this off for people who are getting into retirement?
That is astonishing that 72% of retirees wish they would have done a Roth back in the day when they were contributing to your accounts, which is amazing to me. And here's the history behind it. Back in the 90s, you just don't know what you don't know. And in the 90s, you're contributing to your 401ks, you're getting your matches, and they're going to say, this is growing tax deferred. And then one day you're going to live on the money. So why would we put our money into a Roth back in the 90s if we couldn't get a write-off? Because the story and the myth is, hey, when we retire, we're going to be in a lower tax bracket. But that doesn't happen, right? And most retirees now, fast forward, are that didn't happen. And now I wish I had money in that Roth. So it's never too late to contribute to a Roth. We do tax planning. We are rolling IRAs over to Roths every single day. Some people do $15,000. Some people do $250,000 a year, depending on what your goals and your wishes are, how much you want to leave tax-free to kiddos and to your widows. So there is definitely a tax plan that needs to be ran. Every household that is getting ready to retire 5 years before retirement should have this tax plan already dialed in. You should know when we're rolling IRAs to the Roth. It's either going to be while you're working and or when you're retired if your income's going to be lower. And we got to work on the plan, not last minute. And we're doing lots of last minute planning. I mean, I sat down with a 72-year-old just the other day, and we're rolling IRAs over to a Roth because they're like, I want this tax free for my spouse because she's going to be hit with huge taxes, your widow's penalty that you talk about. And like, she's going to pay $14,000 more in taxes every year because I die. And then my kids get stuck with the bill, and nearly 40% of whatever I worked my darn butt off for is going to go to Uncle Sam. He's like, no, thank you. Not when I can burn and turn and move these IRAs to a Roth today at a 20% tax rate. And I went, praise Jesus, you're right, let's move it. And so, people are starting to understand, and this is why 72% of retirees out there wish they had a Roth today, because now they see the pain, they're feeling the pain, and then when we show them in the tax plan the next 30 years, all day long, it makes sense to go ahead and roll.
Well,
hey, unless taxes go down, if I'm wrong, if taxes go down from now, then maybe you should never roll your IRA to Roth. But I don't
what's
think
the chances of that?
What's the chances of that?
Well, a couple of weeks ago, we did a story about a 90-year-old who wrote into one of these columns and said he had not done a conversion, and now his RMDs are over $100,000 a year, and he's just choking on that.
Well, let me just tell you, a couple who came in brand new, I said, here's the tax strategy. This was their second appointment. And I said, here is what it looks like when you turn 75 and you take your RMD. Their first RMD was $108,000. They have a pension, they have 2 Social Securities, and they have cash rents, right? They're like, oh my gosh, we don't even need the income, and we're forced to take it out. I said, yes. So why don't you do it now instead of the remaining 30 years of your life? Because you're going to pay nearly double in taxes by doing that. And I'll show them the math. Here's the double taxes because you just decided to do nothing and stick your head in the sand. They're like, oh my gosh, let's do this now. I don't sit with people that say, no, this is a dumb idea. They're always like, how fast can we do it? I'm out of breath.
Well, this is, as I say, a retirement plan isn't a retirement plan without a tax plan, and that's certainly what we're going to be talking about. Well, but income planning, tax planning, estate planning, all the different kind of planning that goes into building a retirement plan for you. Give us a call, give us a look. Let's get started. 833-368-3680. 833-368-3680, or use our website, zinniawealth.com. Hit the gold box that says complimentary retirement consultation, and you'll be on your way. Sharice, that is all the time we have on today's show. I'll give you the last word.
We appreciate you all. Thanks for tuning in each and every week. Live by design and not by default, and we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and/or categories usually do not deduct transaction and/or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.